Streaming from Oklahoma's own digital studio, this is Dave Davis with Your Money Matters.
Dave Davis here, thrilled to be with you this morning for our first ever digital studio segment. What is this? Well, for the last few months, I have been focusing my reporting on financial reporting, especially personal finance, family finance. What does all this financial news and inflation and tariffs and grocery prices, what does it have to do with you and me? Stock markets, right? Big picture things. So I've been trying for the last few months especially to really break that down and focus my efforts on that with the help of experts. Because of course, I'm a journalist. I am not a personal financial planner by trade, and I should say that with any sort of things that's perceived as investing advice. I'm not a personal financial planner. I'm not a former stock market broker, but I have talked to people who are and who were. And that is where it gets exciting, because talking to these experts, a lot of them Oklahoma-based, how do you build wealth? What are some, I don't love this term, but tips and tricks, ways that you can make your dollar stretch further for your family and for your future? Because we're talking about, a lot of times what we focus on is, okay, paycheck to paycheck, we've got to make sure the bills get paid. There are some things that we can put off financially, streaming services and vacations, but there are other things like bills that we cannot, and mortgages and rent that we cannot put off, and we have to figure out how to make everything stretch even further, which seems harder and harder now. But my goal with these is not to scare you. We're not scaring people, but we're educating all of us. And that includes me as I talk to these experts, educating everyone the best that we can on how to make your money work for you and your family and your future. So our first guest, our inaugural guest, I am so excited here this morning. We have Steve Wyett from BOK Financial. I've talked with Steve a lot over the years. And Steve, good morning.
Good morning, Dave. And may I just say to start with, I really appreciate the way that you're approaching this and the idea that trying to help people understand that some of these broad economic things that we talk about, they do have an impact on us, but that doesn't mean we're powerless. We can empower ourselves to try and deal with some of these things. And I love the way you're approaching this, Dave.
Well, thanks. And I really hope that folks at home are getting a lot out of this. We're going to put this on YouTube. We're going to put this on newson6.com firstly, and our YouTube page as well, just to make it as accessible as possible. Social media too. So Steve, let's start with the stock market. A lot of people are invested. Something like 40% of working adults are invested in the stock market as a part of their retirement plan. And you can correct me if that's wrong, but something like that. Stock market, what's going on with kind of the ups and downs? What are you seeing?
Yeah, it's at least that high. And particularly as you're talking about retirement assets, Dave, that's where the vast majority of people are going to have this in their 401k or some type of retirement plan with their employer. So yes, the stock market is important to the economy. And it's the good thing about the stock market is it's been going up over time. In fact, if you just look at longer term investors, can I just throw Warren Buffett out there, who was over the weekend announced that he's retiring from Berkshire Hathaway. He's been in that post for something like 60 years, which is unbelievable on its own. But his compound return over that 60-year period of time is something like 1.5 million%. Highlighting how important time is in the investing and to be disciplined in your approach. It can be very scary at times because look, the fact is the stocks go up, they go down. We've had those periods here this year where at one point the S&P 500 was down almost 20% from its recent highs. That calls into questions whether the economy is going to continue to grow. There's always things that throw us for a loop. We've seen stocks down 20% in the past. And Dave, I'll go out and make a prediction. They're going to go down 20% again at some point in the future, but that's just part of how this is going to happen. The idea, though, is that if you stay disciplined, stay invested over time, there's been very few asset classes that have outperformed stocks. And so the stock market's important. And I just might mention since the Liberation Day announcement that really caused the recent decline in the stock market, we've now recovered all of those losses over the last couple of weeks. In fact, we had 9 days in a row of the S&P 500 being positive. That's the best streak in 23 years. So just when you think things look really bad, sometimes they can start to look a little bit better as well.
And that's what we're trying to do. I mean, we're trying to show different sides of things. For example, just a couple things here. So jobs report, we talk about jobs report, 177,000 jobs added in April. That is about 40,000 more than were expected. What is your take on the jobs report and your analysis there?
So, Dave, we think the jobs report, we get that out every month from the Department of Labor. It comes out on the first Friday of the month. It's the single most important economic data point that we get because our economy, U.S. economy, 2/3 is based upon consumer consumptions, consumer spending. Consumers with a job are much more likely to spend money. That's more likely to support the economy continuing to grow. And so when we look at that job report, we're looking for, you mentioned 177,000 in new jobs. That was more than we were expecting. The overall unemployment rate stayed stable at 4.2%. We saw the labor force participation rate, kind of a measure of how many people are involved in the labor force, that went up a little bit. Average hourly earnings, you would think, well, was that good? It was actually came in 0.1% less. We like that because that means less inflation from a Federal Reserve standpoint. They're a little concerned about inflation, so if we want the Fed to lower rates, we'd like to see that number lower. We got that. And so overall, if you just look at this number, you go, wow, that's going to be really supportive of the economy going forward. The hard part is that survey was taken the week after the tariff announcement. It may not have been fully impacted by that. And so with most of the economic data right now, Dave, we kind of have pre-Liberation Day and post-Liberation Day. We're still waiting to see some of the post-Liberation Day data come in. That's what the Federal Reserve is looking for. But overall, it just shows that the economy is in solid shape. 4.2% unemployment is unbelievably low in the history of our economy.
You know, some people were looking at that GDP number. Just explain what GDP is, why it's negative, because didn't the data also show that people were buying stuff ahead of tariffs, that people were buying up stuff, dealers were buying things. So how does it go down if people are buying things, Americans, you and I, buying things in anticipation of the tariffs going up? How did the GDP go down? You'll have to explain that one.
So you're right. GDP, which stands for Gross Domestic Product, it's a quarterly measure of kind of all of the activity in our economy. It came in for the first quarter. We get our first look. We're going to revise this number 3 times, I think, Dave. So that might not be the final number, but it showed a decline of 0.3%. When we do the GDP calculation, imports detract from growth. It's a minus sign from growth, and that was about 4.8%, minus 4.8%, because as you pointed out, companies were trying to import a whole lot to avoid any future tariffs. The offset to that, inventories were up. That added about 2.3% to growth, but that wasn't as much as what the imports were higher. So yes, GDP came in negative, but real spending was higher. I can tell you, car sales, just looking at auto sales in February, they were running about 15.5 million on an annualized basis. In March, that expanded to 17 million. We happen to have some car dealerships that we know. Yes, they did. They imported a whole bunch of cars. That impacted the negative part of that import number, but they wanted cars on the ground to be able to sell on a pre-tariff basis, and they did sell a whole lot of cars in March. So this GDP number is kind of, the good part is you're right. People were spending money. People were importing, but that's just the calculation. And I think that really kind of gets to how President Trump looks at the trade deficit. He looks at that as more of a negative, kind of like the GDP number. But you and I would look at that and say, well, that's only a math issue. The fact is, this was indicative of strong demand in our economy for these goods. They were just trying to get those goods imported before there were tariffs, so they would continue to have inventory to sell as we go forward. I think this really highlights that GDP going forward is going to be based upon how the tariff negotiations go from here. Those inventories will run out. They'll eventually sell that, and then it will be how companies look at replenishing that inventory that they've sold that will be really important for economic growth going forward.
So a couple things that you were talking about, Steve. First of all, Energy prices. Okay, so we're talking about cars, people importing cars, dealers importing cars. We want to get cars in ahead of the tariffs, get cars in. Is it just me, or are gas prices going down? I mean, oil's down to like $57 a barrel. Oil per barrel is going down. Does that mean our gas is at least going to be cheaper? Give us a break there.
Well, gasoline is cheaper. And Dave, I would point out there's no single economic data point with a tighter correlation to the president's approval rating, any president's approval rating, than gasoline prices. So every president is sensitive to gasoline prices as they think about it. This has less to do with car sales. Dave, there was an OPEC Plus meeting over the weekend that's primarily headed up by Saudi Arabia and Russia. They announced they were going to increase some production. That's causing oil prices to fall a little bit here today. And yes, as oil prices fall, we'll see gasoline prices continue to come down. Now, I think most consumers need to understand when I say gasoline prices right now on the open market are trading at about $2 a gallon. They go, wait a minute, I'm paying way more than that at the pump. Certainly there's some distribution costs, but let's remember that many areas tax gasoline pretty heavily. And in some states like California, where gasoline's still over $5 a gallon, it's just because of the tax implications on what they're doing. But here in Oklahoma, we've got gas prices, $2.30 or so for unleaded. And so, yes, we're going to see some benefit from that. That's going to flow through to maybe lower electricity rates and all of the things that are tied to energy. But it's that's on the oil price front. Natural gas, it's interesting right now. Natural gas, we're kind of looking at it separately. I would say this, Dave. And we have a lot of natural gas in the United States. It's a huge resource for us. It could be very important as we think about moving forward from a trade standpoint, because there's a lot of countries that can't afford to buy a lot of our goods, but they need energy, and liquefied natural gas is something that could help fill that. So look for the LNG market, liquefied natural gas, as a potential real positive for us from an economic standpoint moving forward.
Right. I mean, it's summer here, but it's winter in the southern hemisphere, and
Sure.
it's how people heat their water, and it's not just about heating your homes. It's your water heater. It's just everything. That's really a good point. I have another question.
It's not just that, Dave. It's electricity. Think about electricity, and this is where AI and all that comes into it. Sorry to interrupt. Go ahead.
No, I wanted to talk about interest rates. We've briefly gone over it, but this, I think, hits home for people's wallet because, okay, so like I'm using my credit card to buy groceries now, and like rent's getting a little tight. Like I'd like to get into that house, but like the interest rates, like I'm trying to buy a car, the interest rates, it just seems like we're kind of going back to it's expensive to borrow money in America more than it has been recently. I mean, 2% interest was, you could argue, historically low what it was 3 years ago. But do we think we're going back to 2-3% interest on mortgages?
You know, Dave, I'm going to answer that question in maybe what might be an unusual way. I hope not. And here's why I say that. I think those ultra low interest rates of the mortgages at 2.5% to 3.5%, those are going to be the exception, not the rule. The only way that we would get back there is if the Fed would have to drop interest rates back towards 0%. Remember, as savers, we weren't earning anything on our savings. Our money market rates were a basis point. They weren't helping us achieve any long-term financial goals. So savers were really paying a price as interest rates were that low. I hope the Fed doesn't have to take interest rates that low, because that, if we do, that means we've had a pretty bad economic outcome. That would mean unemployment would be a lot higher. It would probably mean there would be other things that might be keeping us from buying our house. So for homeowners, I would say this: if we just think longer term, somewhere between 6 and 8% has been the long-term averages on mortgages. We're at about 7 right now. We do think the Fed eventually will continue to lower interest rates. But importantly, Dave, the Fed does not control home mortgage rates. That's the long end of the curve. It's been pretty stable over the course of this year. Short-term rates have come down some. That might help some on credit card debt, Dave, but I got to tell you, another 50 basis points lower on interest rates from the Fed, that's not going to make credit card debt affordable in any real sense of the word. And so, kind of getting back to your opening statement, for consumers, as much as you can avoid credit card debt, avoid credit card debt. It's just very expensive. I think the average rate is still up over 20% on most credit cards. And man, that just adds up in a hurry. The Fed will be lowering interest rates as we get to the end of this year. But that's because we think inflation is going to continue to come down slowly. But they're not going to get back to rates that are ultra low that we saw previously. And again, I hope we don't see rates that low.
And this may be like a macro question, but as folks were talking about, I'd like to see prices come down to the grocery store. Obviously, all of us would like to pay less on groceries. How does that work? Are we just going to notice fewer changes and they're not going to keep going up? Or do you think prices on consumer goods can materially drop and we can be paying less on our bills and our budgets can breathe a little easier?
Dave, I would say this: there will always be some parts of what we're spending money on that are dropping. Egg prices are down a lot from where they were on their peaks, but overall, we're just at a higher price level than we were before we went into the pandemic. Overall prices are up a little over 20%. You're going to see some areas where they're going to drop, but I wouldn't look for broad price declines like cars, insurance. All of the things that we spend our money on, they're not going to get cheaper. I would say we're not going back to where we were before we went into the pandemic. What we hope over time is wages can continue to grow, that can catch up a little bit. But this is why inflation is so difficult to deal with. It actually hurts those that can least afford it the most. And so this is why inflation is the number one part of the Fed's goal, to keep inflation low, hold prices as stable as possible. To get them actually lower, we'd have to go through some period of deflation. And Dave, deflation, particularly in a levered economy, and let's say this, let's define deflation. If house prices fall, so it's easier for somebody trying to buy a house to get in one, that means somebody that owns that house that may have a mortgage is seeing the value fall, and maybe it falls below their mortgage value. They have negative equity in a house. That's a really tough situation. Remember, that's what happened during the financial crisis in 08 and 09, and that was a very difficult period for the housing industry as we went through that. So getting prices to get stable, allowing our wages to catch up over time, that's the best way to think about this moving forward. But it's why inflation is so important to the Fed.
Well, Steve Wyett with BOK Financial, we thank you so much for your time. You're the Chief Investment Strategist at BOK Financial. We've talked a lot about the economy. Obviously, we just had an election that you could argue was about the economy. And so I would imagine that this is going to keep coming up and will keep coming back to experts like you, and you particularly. Steve, we really thank you for your time today.
Thank you, Dave. And I would just say, look, we remain more optimistic than pessimistic. We need some good things to happen, but we think that they will over time. Don't bet against America, Dave. That's not a good bet.
All right, Steve, thanks. So that was Steve Wyett with BOK Financial. We so appreciate his time. So what we're going to do now is we're going to try to come back with this segment regularly, different experts, different guests. We might be talking about credit card debt one day. We might be talking about buy now, pay later. We're hearing a lot about that. So what does that mean? Like, is it just immediate interest? If you make your payments, then you don't get interest? Are the fees? Like, a lot of people are using buy now, pay later, so I like to talk about that. I want to talk about student loan debt in the future. I know a lot of us out here who are paying those bills and we're thinking, oh, it's canceled. Oh, no, it's on pause. Okay, now it's back. Okay, now it's stop, start. I know there's a lot going on and a lot of, frankly, noise out there. So this is going to be a great venue, I think, in the future, this News on 6 digital studio. We're going to try to be doing this weekly for you, talking about all these issues that affect our pocketbooks, our wallets, our checking accounts, our banking accounts, our credit card balances as well. So again, I'm Dave Davis. Your money matters. Just remember that here on News on 6. And we are going to post this, so keep watching newson6.com, our website, as well as our YouTube page. And we will see you back there later. Have a great day.